Hey, what's up, everybody? My name is Johnny, and today I'm going to be talking about 4 different ways that you can invest in the stock market that have all been proven to work extremely well. Now, before we get into the video, I just want to throw out a disclaimer. I'm not a licensed financial advisor, I'm not a professional. I'm simply doing this for entertainment purposes and just sharing some things that I found out have worked pretty well for me along the way. And now, onto the video. So a lot of people that do financial educational content talk about investing will tell you that there's only one specific way that you can make money in the stock market. That's not exactly true. See, there are some basic principles that you have to apply if you want to continue to make money over the long term. But past those basic principles, there are actually multiple different styles that you can use. Now, I've made other videos going over these basic principles, and there's really 3 main ones that you need to follow at all times. Number 1, a stock is a business, a real live living company. Number 2, the stock market fluctuates and you can't let it control you. You have to be patient and wise and use it to your advantage. The stock market is your servant, not the other way around. And number 3, you have to buy with a margin of safety, which simply means buying something for less than what it's worth. So, past that, there are a lot of different ways that you can incorporate these basic principles to make work for you. And over time, you should be able to find one that works best for you and use that one consistently. There are 4 specific ones that I want to talk about today that have all been proven to work great. Number 1 is simply dollar cost averaging an index. So, an index in stocks is a large collection of stocks, and when you buy into it, you're just buying the average. So for instance, like the S&P 500 index or the Dow Jones Industrial Index or the NASDAQ index, where you're simply buying a large selection of stocks that are representation of the market as a whole. And you continue to buy into it and you simply get the average. This has been proven to work great over time, most people getting an average of 10% a year over the course of the long term. And that works great. It's what a lot of people do in their retirement accounts and their 401k. And there's a lot of different indexes that specialize over different areas, like I said, whether that's the S&P 500 or the NASDAQ or extended markets for smaller cap companies. Number 2 is quality compounding. This is something that a lot of professionals actually go towards because it's been proven to work extremely well by the best investor of all time, Warren Buffett. And what he does is he looks at various companies. He normally makes very few investments in a given time frame. He tries to find the best company that has a huge runway of growth on it and buy into it and sit on it for years and let it to continue to compound and compound. Now, this works great, and a lot of people have done this extremely successfully, but you really have to know what you're looking for. You want to be able to find a company that you can determine has a long runway of cash growth, because that's what we want as investors in a company, is for a company to have a lot of cash and to continue to grow that cash. Again, this takes a huge level of patience and definitely a lot of research, because you're trying to find the best of the best companies out there in the world and then sit on them. Now, something that a lot of people don't know is that before Warren Buffett started using this method, he actually used some of these other methods that I'm going to talk about in a second, such as statistical investing. Now, in statistical investing, you're basically using a precept of various statistics piled on top of each other and buying a basket of stocks where you're not so much focused on the specific business, but on the different statistical numbers that they have. For instance, how much cash they have on the balance sheet, how low their PE might be, how high their book value might be, things like that. There's a lot of different ways that you can combine these, a lot of different ways that they work. For instance, Joel Greenblatt, he has the little book that beats the market, where he uses primarily a combination of low PE and high ROE stocks and buys it as a basket. You have Tobias Carlyle. He's written his book, The Acquirer's Multiple, where he primarily focuses on the EV to EBITDA, or the enterprise value to the earnings before interest, taxes, depreciation, and amortization. There are a lot of different metrics that you can use and combine them to make this work. Another way that a lot of people have done it, especially back in the old days before there was before the gap was closed so much by so many people having access to information, you would find a lot of these companies that were trading for less than the cash on their balance sheet. You would simply buy a basket of these companies, and one of two things would happen. Either they would liquidate and you would get that surplus cash paid out to you as a shareholder, or the market would eventually realize how cheaply these companies were trading, and they would buy into them and push them back up to where they should be trading at. Now, of course, this didn't work out for every single company, but that's why you buy a basket of them, and as a whole, it ends up working out very well over the course of a year or two. Now, the last and my personal favorite method of investing that I want to talk about is special situations investing. And this one, it is very focused on the business, but specifically on various events that will happen in a business. For instance, any type of arbitrage would be considered special situations. So when someone makes an offer to buy out another company and the offer is higher than the current trading price of that stock, that would be a form of arbitrage or special situations investing. Another one would be, is actually a company that I've invested in right now, Genworth Financial. They are planning to do an IPO and maybe a future spinoff of a segment of their business. Well, their IPO is valued higher than the current market cap of their entire company. Therefore, when it's IPO'd and everyone sees that just a segment of their business is more valuable than the entire trading price that it's at right now, it'll push the price back up. Ideally, anyway. That's theoretical. But again, that's why you buy a number of different stocks, just in case you're wrong about one of them. Another way that you could do special situations investing is for spin-offs, similar to what we just talked about, but when a company decides to spin off a segment of their company to get other people to realize that there's this valuable part of the company that hasn't been recognized yet. And you can do this in various ways by buying into the company before it spins off or buying the spun-off company from it. Another way, and one that I'm really trying to focus on right now because it's great for smaller investors such as myself, is exploiting tender offers. And a tender offer is typically carried out when a company wants to buy back shares and it decides to do so directly from its own shareholder. And in a theoretical situation, it'll make an offer to each individual shareholder and say, our stock is currently trading at $2. We will give you $2.20 in cash for every share that you own. In which case, if you're aware of the situation and can get on it quickly, you would go buy each share for $2 and then immediately tender it and participate in that tender offer and sell it directly to the company, directly to the organization of that company. So, like I said, these are 4 different methods that I've used all of them personally. They've all worked great and they've all been proven to work over time. The dollar cost averaging and index, buying in quality compounders that you can sit on and forget about, doing statistical investing as a basket, and doing event-based investing of special situations. All of these have been proven to work amazingly well by various investors over time. So that's just a basic overview of some different ways that you can use money in the stock market that should give you good returns over time. Just make sure that you're doing your research, that you're putting the time and effort into it that you need, and you don't just take my word for it. Really like to do your own homework, do your own studying on it, and hopefully you'll have good results over time. Now before I go, I just wanted to throw out a few things here. First of all, if you see me flash around this bracelet, it's an awesome bracelet from an awesome company called Pure Vita Bracelets. There's a link in the description below. You can go ahead, click that link, it'll take you to purevitabracelets.com, and you can get a bunch of cool products like this for 20% off if you use the promo code at the checkout, DelaneyLang20. That's the promo code used at the checkout. You can get 20% off a bunch of cool items like this. Also, down below is a link that'll take you to a promo code for Webull. I personally like Webull a lot. I use it for a lot of my various investments. If you click on that and use the affiliate link that's in there, you and I will both get some free stocks simply for you opening a new account, and I think you might have to put like $50 in there. So for doing almost nothing, you and I both benefit from it, and hey, that'll be awesome. So don't forget to like this video, don't forget to subscribe, go ahead and comment. It really helps the algorithm out, and I'll see you guys later in another video. Thanks so much. Bye.